So without any further ado, I'm really excited to bring on our next speaker, Grace Taylor from Gracefully Expat.
Thanks, Johnny. Hi, everybody. My name is Grace Taylor, and I run Gracefully Expat. It's a U.S. tax consulting and compliance practice. So who am I? Well, I'm actually originally Canadian, even though my specialty is U.S. tax. I ended up transferring to the University of Washington, if anyone knows Seattle, and I graduated from there, and I ended up in the corporate world. And I specialized, actually, when Kristen was saying about the global mobility sphere, that's what I was working in. I was doing the tax stuff for those guys going on the expat packages. And somewhere along the way, I realized that there was a need for good quality tax information for people like yourselves, for the digital nomads, the entrepreneurs, the people who are bootstrapping and don't have that big company budget paying the likes of a Big Four firm, which I used to work at. And it was a great experience, and I certainly learned a lot. But of course, big companies pay the likes of the Big Four thousands and thousands of dollars per expat return. And when you guys don't have necessarily the budget for that, but you still need the quality tax advice. So that's really why I went into business for myself. So yeah, I started out in Canada. I ended up in the States. I took a transfer with KPMG to Ireland. And that's where I'm sort of based now, although I'm a digital nomad and location independent myself. So I travel around Europe and really wherever I want. And I provide tax consultations and compliance services to US digital nomads specifically. So as Johnny said, unfortunately, I can't speak to the tax implications of any other country. But as you'll find out, there's reasons why your situation as a Canadian or European might be that bit more straightforward, actually. So, for example, well, first let's talk about kind of the big picture. What are you going to take away from today? Well, taxes can be really overwhelming for people. And I'm not going to hide the fact that when you do become location independent, your tax situation is going to get more complex. But the good news there is your actual overall tax burden can improve. And I think that's kind of why we're all here today, to figure out exactly how that works. And after this presentation, you're going to learn how to get the facts that you need to know, make a plan, and really get out there and start enjoying all the benefits of this lifestyle. So why is it so different for Americans? For example, I'm a Canadian citizen, and I no longer live in Canada. I haven't for many years. And the fact of the matter is, I don't have a Canadian tax residency anymore, and I don't pay Canadian tax. Simple as that. When you hold US citizenship, or in fact, if you're even a US green card holder, your situation is completely different. And the reason is because the US has this concept called citizenship-based taxation. So this is kind of our fundamental baseline that we have to start with. It means that even if you don't reside in the United States anymore, as long as you're still a US citizen, actually even if you hold a number of other citizenships, if one of them is a US citizenship, you're subject to US worldwide income reporting every year, forever. But the good news is there are specific tax provisions that you can take advantage of when you don't live in the US anymore. And that's what we'll really cover today. But just so you know, the US is completely unique in this regard. There's actually one other country that I'm aware of that employs citizenship-based taxation, and it's Eritrea in Africa. So there you go. If you happen to be Eritrean here, you're going to need to find some tax information from them as well. So there's one big one when it comes to expat tax stuff, and this is probably the one, if I had to guess, that maybe some of you guys have heard of before. But the problem is there's a lot of misinformation out there about it. And so what I really want to cover today is make sure you understand exactly what you need to know to make use of this thing called the foreign earned income exclusion. And really all of those words in that definition are pretty important, and we'll kind of cover them, I think, so you understand exactly what it means and how it can work for you. But basically, this is the main way that US digital nomads can reduce their US tax burden when they're working abroad. So we're going to get into kind of some of the tax nerdy stuff. So just bear with me on it because it is going to be useful for you to really get this. So when you're out there researching the foreign earned income exclusion, you're going to find that there's a couple of tests that you need to qualify for it. And there's these two big tests. And I'm going to talk about each of these and which one of them I think most nomads can make use of. But one of the things actually some of my clients come to me and say is, well, I can't qualify for either of these because I looked it up and I did the research. And they have this thing called the tax home test. And I don't have a tax home anywhere outside the US, so it's off the table for me. And believe it or not, I get people coming to me who should have been claiming the foreign income exclusion and saving thousands of dollars a year. And they didn't do it because they kind of self-diagnosed. And unfortunately, they did it wrong. Because this stuff is so complicated that unless you really practice it day in and day out, don't trust, as smart as you guys all are, just don't trust your own literal reading of the IRS website because it's not going to be helpful. So suffice it to say, the first test you need to qualify for the foreign income exclusion is called the tax home test. But the good news is if you qualify for one of these two, you already qualify for the tax home test. So essentially your tax home is, it's not where you have some kind of legal residence or anything like that. It's as simple as, where do you wake up every morning and go about your business and get to work? If that's no longer in the United States, then your tax home is outside the US. It's as simple as that. And then we get into the more technical stuff. So there's two tests that you need to qualify for one of them. You don't need both. And they are called the bona fide residence test and the physical presence test. Of these two, you're going to understand why the vast majority of digital nomads need to look to the physical presence test. The reason is because it's as simple as counting your days. But have some caution with how you count your days because there's a lot of kind of misunderstandings about exactly how it works. So you need to be physically present in a foreign country that's not the United States for at least 330 days in any 12-month period. The 12-month period can start or end anytime you want, but it needs to be a consecutive 12 months. So this is kind of the hard thing that people need to get their minds around is even if you don't have 330 days in calendar year 2018, for example, from January until December, you can still qualify under PPT. And the sort of simplest example that I use is, let's say after this, you're also inspired and you're going to go and move to Thailand or wherever. And let's say you leave the US and begin your kind of semi-permanent travels on October 1st. Well, your 12-month period could be October 1st, 2018 to September 30th, 2019. And then you count your days from that period. And what it means is in your departure year, you can qualify for a partial exclusion. So don't think you need to wait until you've been outside of the States for a full calendar year. You can still get a partial year exclusion in your first year of travels. And the other nice thing about the physical presence test is all those 330 days, they don't need to be in the same country. So you can travel to 52 different countries and spend 1 week in each, and you still qualify. You can travel to one different country a month, and 12 different countries have the 330 days, and you still qualify. So it's really about counting your days in a foreign country. One weird little quirk that I think Kristen mentioned is, like, maybe you guys have heard of the Nomad cruise. It's another kind of nomad event that I haven't been on yet, but I think Johnny's been on. It sounds pretty cool. But the weird thing about that is because those days that you spend on international waters, you're not physically standing in a foreign country, those days don't count. So you have to be a bit careful about how you count your days. And the other downside to this one is it really limits your time that you spend back in the US with your family. So I'd say when I talk to my clients, that's their biggest kind of regret about it, is that they wish they could spend a bit more time back in the US. The second test, which doesn't work for most digital nomads, at least when they're starting out, is called the bona fide residence test. And this one, it's a little bit more, we'd call it a facts and circumstances test in the tax world. It's a bit more touchy-feely. And what it really requires is you do need to have a legitimate residence in a foreign country. It can change. It can change from maybe you move to London and then you move to Hong Kong. Your bona fide residence can be in London 1 year and in Hong Kong the next. But one thing that you do need to have, which most digital nomads don't necessarily have when they're first starting out, is a legal right to live and work in that country. So you can't just be there on a visa exemption. It doesn't work at all for bona fide resident test. So if you're just doing the hop from country to country every 3 months, BFR is off the table for you. But if at some point you settle down a bit more and do develop really more of a permanent home base in another country, the nice thing about BFR is it allows you more time back in the US every year. So it's not a hard and fast rule, but we tend to say you have about 4 months that you can play with each year and still legitimately be considered a bona fide resident of a foreign country. So there's your baseline for how do you even qualify for this provision. And unfortunately, if you're going to spend most of your year in the US, you're not going to be able to avail of this. But if you're thinking about it, here's why it's so powerful. Because it's an exclusion from income tax, it's basically, you can think about it as negative income. So if you're envisioning, say, your 1040 form, and you've got, your income, let's say from your W-2, it goes on line 7. You guys wouldn't know that, but I'm a tax nerd, so I do. And then later on down the form, it basically subtracts that. So it's, as Johnny said, it's up to around $100,000 that's excluded from the federal income tax per year. That's if you qualify for the full exclusion. So if you think about that, that's pretty powerful. That's a lot of extra money that you could reinvest in your business or just live a more luxurious lifestyle. But the foreign earned income exclusion is really, really powerful, but it doesn't do everything. So one thing is the income has to be earned from working. So investment income does not apply here. Capital gains, selling crypto, real estate investment income, that kind of thing, from rental property, that's not earned income. But income earned from working for an employer, income earned from freelancing, income earned from working on your own business, that does qualify. However, when you're working on your own business, most people will be subject to this thing called the self-employment tax. So that's why not for every digital nomad, you're not always going to get to a zero tax bill. And it is important to be aware of that. Because the self-employment tax, you might not have heard of it named as such, but what it really is it's your employee plus the employer portions of Social Security and Medicare. And if you're self-employed, the bottom line is you are just going to have to pay that. And it's around 15%. So the kind of rule of thumb that I would give to my clients is if they're generally making less than about $100,000, but they are subject to the self-employment tax, just take 15% of their net income from self-employment and budget that for taxes. Then the other thing about it is, and this is something that people don't always get right, sometimes people tell me, well, I didn't make more than $100,000, so I don't have to file anything. Unfortunately, no, you really, really do. And this exclusion is only available if you claim it. It's actually an election, that's a particular tax word that we use, but you have to elect it on a properly filed tax return. You can file it on an amended return. So if anyone's out there thinking they should have claimed this in the last couple of years, come talk to me because it's maybe not too late, but you really do have to file a tax return and claim it to get it. And the tricky thing is if you've usually used like TurboTax or some of this, just generally free or cheap software, it's not always well supported by those programs. So that's really why I try and step in and help people through it because, if they're used to preparing their own tax returns and just, plugging in their W-2, this gets just that bit more complicated. So another thing that my clients sometimes ask me is, or sometimes, they sort of self-diagnose, and they say, well, I can't claim it because I have all of these things that link me back to the US. And so have a look down this list, but none of these things will preclude you from claiming the foreign income exclusion if you qualify for it under one of the two tests, and if your income is earned while you are physically standing or sitting in a foreign country. So that's what makes foreign source income. So understanding the concept of income sourcing is actually pretty important because it doesn't have anything to do with any of these factors. It's really down to where are you physically located each day in and day out when you're earning that income. So you can have US clients. You can work remotely for a US employer. They can actually still pay you on a W-2, and you can claim the foreign income exclusion. You can sell physical products into the US on Amazon FBA, etc. You can get paid into your normal US bank account in US dollars. It's totally fine. You can use a US mailing address for just forwarding a PO box, a friend or family's address. That's perfectly acceptable. And you can actually operate your business through a US structure such as an LLC. All of these things are fine, and they don't turn your otherwise foreign source income into US source income. That's just not how it works. So I hope you guys can see this. I have a comparison here of actually a pretty typical scenario that I see. An awful lot of people would come to me having previously been a W-2 employee, and then they start two things at once. They oftentimes start a digital nomad journey as well as an entrepreneurial journey at the same time. And this is sort of a simple kind of calculation to compare exactly what the foreign earned income exclusion does. So we've got Steve here. Steve is just a regular W-2 employee working in the US. The state tax that I've chosen there is California. I think there's probably a few Californians in the audience. Anyone? We'll talk about you guys. You guys have some challenges. But that's where the state tax comes from. So you can see here, Steve takes home $70,000 after federal, state, and FICA. FICA is the Social Security and Medicare. So that's pretty good, you know, that's not bad. But let's look at what happens when Danny here takes his location-independent business on the road. He earns the same amount. So he earns $100,000, and keep in mind, this is net after expenses. So this is really what he earns after he subtracts all of his regular business expenses. This is his sort of net taxable income. He pays 0 federal income tax because he qualifies for the full exclusion. Let's assume he's successfully broken his state tax residency. We'll talk about that. And so then he pays 0 state income tax. The one thing that he's still stuck with for now is the FICA tax, which is the self-employment tax. And you can see it's roughly 15%. It's a little bit less, which is a boring calculation you don't need to know about. But when you're budgeting for it, think about 15%. But you can see here, he's saved more than $15,000 just by the fact that he doesn't live and work in the US anymore. So if your lifestyle otherwise supports this, you can see here, you know, that's pretty powerful, because if you're reinvesting that into your business year after year, you know, you can see how that can really start to develop some exponential growth. As well as, and you know, this is just the straight numbers, but Danny here might be living a really much more luxurious lifestyle than our friend Steve, because the cost of living in other countries is oftentimes a lot less. He's probably not commuting and wasting all of his time, you know, on the freeway and traffic. So, you know, there's a lot of benefits. But the fact of the matter is, the numbers just show what they show. However, there are, of course, besides the regular federal income tax, there's other taxes to consider. So I like to just include this so that people keep an eye on their worldwide tax burden, and don't just focus on the foreign earned income exclusion to the exclusion of all else. So there's state income tax, which we'll dive into in the next section. And there's foreign taxes. I just put this up there to be aware of, if you're staying in a country long term and you're becoming a tax resident there, then you may have to pay foreign taxes. It doesn't get you out of reporting that income on your US tax return. But what you can do, and we'll talk about this a little bit later, is you can actually claim those foreign taxes as a credit, so you won't be doubly taxed. And then finally, if you're selling physical products, you're already aware, it doesn't change the sales tax at all. So if you're paying sales tax because you're selling physical products into states that have a sales tax, that stays exactly the same. So none of that changes by the foreign income exclusion. Let's talk a little bit about state tax issues, because the foreign earned income exclusion applies to the federal income tax. That's the one that the IRS administers. However, we have 50 states, and they all operate completely differently. And they all have their own Department of Revenue and their own tax laws. So here's kind of a high level, so you can understand, based on the state that you're from, what you need to know and what you need to do. So because it varies so widely, I've divided the states into what I call the good, the bad, and the ugly. You'll see that it's never really that bad, although California can be a bit ugly. But just so you can kind of analyze based on your state whether this is something that you need to devote a bit of time and energy to or not. So we'll start with the good states. When I lived in the US, I lived in Seattle, and Seattle is one of these that doesn't have a state income tax. So raise your hand if you're from one of these states. You guys, lucky guys. Life's just that bit easier for you because, as you know, you just need to file your regular federal tax return. There's no state tax return for you. There's some really attractive states on here. If people are just looking to kind of do some geographic arbitrage within the U.S., Washington is a great place to live. I've lived there. Nevada, where we are today, obviously is pretty cool. Florida, Texas, these are some attractive places to be. And then the two up there, Tennessee and New Hampshire, these functionally don't have a state income tax either. They don't tax employment income. They only tax interest and dividends, and only for now, actually. I think both of them have provisions that they're looking to phase that out. So if you're from one of these 9 states, then you've got it easy. So we can safely move on to essentially most of the rest of the 50 states. These are not bad states to be from, of course. They're lovely places, I'm sure. But what they are is they just present that additional challenge, and you have to do what is called breaking residency from that state. So you can think about it as breaking up with that state. Some states make it harder, some states make it easier. But these states will essentially allow you to say, right, I don't live here anymore, so I'm kind of exiting from your tax system. Thanks very much, it's been great, but see you later. So what mostly you do if you're from one of the other 50 states is in your year of departure, you file what's called a part-year resident return. And it's pretty simple. You basically say, right, I was a resident from January until, let's say, October. And then from October onwards, I don't live here anymore. So I don't spend most of my year here. I don't have what's called a domicile here anymore. And you're basically telling the state, right, henceforth, you can expect that you're not going to get a tax return from me because I'm not a resident here anymore. And most states are okay with that. So it's just one thing that we additionally do in your departure year, and then hopefully for the rest of the time that you're living outside the US, you don't have to worry about state taxes either. Now, what are the ugly states? Well, there's essentially 4 states that if we're using the breakup analogy, you might call these your stage 5 clingers. They don't want to let you go. They really, really, really like your tax revenue. So New Mexico, South Carolina, Virginia, and California make it hard to break residency. It's still possible. But there's one state that is just a perennial tax challenge. And it's a lovely place, and there's a great many Californians here today. But California is challenging for a number of reasons. So not only is it hard to break your California state tax residency, California does not honor the foreign earned income exclusion. California doesn't even honor international tax treaties that the US government has signed off on. California's just like, no, we're not going to do that. Okay. And then also, if you guys have ever worked with the California Franchise Tax Board, I have. They're really aggressive sometimes. So we have to play quite nice with them. And all it means is don't let it stop you if you're from California and you want to go on this digital nomad journey, but be aware that you have to take some additional steps. And Johnny gave me an example that basically he's from California as well. And if he had moved his tax residency in the US to Texas a couple of years earlier, he would have saved a good amount of money. So for you guys finding this information out now, hopefully it's going to be quite powerful for you. But what a lot of people from California would be well advised to consider is California somehow seems to respect it a bit more if you move from California into another US state before you just eventually move out to a foreign country. So what a lot of people do as a strategy is they would shift their tax residency to, let's say, one of the first 9 states, Texas, Nevada, Washington, etc. And that sort of lets California know that you're not a California resident anymore, but you are a resident of one of these other states, which they seem to find that more acceptable for some reason. They seem to think that if you just move from California to a foreign country or to nowhere as a nomad, they think, guys, like California's so nice, you're going to be back. Your domicile is still here. We know you love us. So I work with clients individually on this, and we can talk about what all of their facts and circumstances support as the best way forward. But keep in mind that it's something that you are going to have to take some additional steps on. But there is a way forward, and working with someone who knows the ins and outs of it, you can figure out exactly what steps you need to take. But a lot of times doing things like changing your state driver's license or your voter registration, setting up bank accounts or having an address in another state, these can all be steps that we can take to support your non-residency of California. Right, so I talked earlier about how a lot of my clients, in addition to being new digital nomads, they're also newly self-employed as well, newly entrepreneurs. And this creates some additional opportunities, really, for taxes, but it's just some things that you might not have dealt with before if you were just a W-2 employee. So I've borrowed Johnny's phrase here because I like it. If you listen to his podcast, you'll know he says, if you want to live like a boss, you've got to be your own boss. And I certainly love being self-employed compared to my life in the corporate world. I'm so much happier. But I just wanted to give you guys some tips on what you should be aware of when you're starting an entrepreneurial journey for the first time. So one of the first things that my clients will sometimes ask me is, what do I do about my business expenses? How do I know if this is a business expense or not? This actually, I think, should cause less stress than it really does for people. And the simple reason is, if it's an ordinary and necessary business expense, then expense it, claim it. That's as simple as that. Sometimes people ask me about things that they would just like my sort of opinion on, which is perfectly fine. But the fact of the matter is, if you need to incur this expense to conduct your business, then it's deducted from your top line revenue. So track these however you want. People use different software programs. I don't have a perfect one. A lot of my clients just use a spreadsheet. I think that's okay too. And be aware that when you're moving your business around, your business moves with you as you're a nomad. So traveling around the world to events like this, to conferences like Nomad Summit Chiang Mai, those are business expenses. If you're there to network, you're there to connect with other business owners, that's a deductible expense. So just keep in mind that the way your business expenses will look when you become a nomad will change a little bit as well. The other thing which is less fun for me to remind my clients about is, if you're going to owe the self-employment tax, one thing that you're going to have to do, which you probably haven't before, is make what's called quarterly estimated tax payments. And these aren't fun to make, but they're really useful to know, because when I get clients coming to me in April who haven't talked to me previously, oftentimes if they have to pay their full tax bill in April, they're going to be subject to what's called underpayment penalties. And these can be avoided with something as simple as paying your tax bill in quarterly installments. And it's really easy to do. You just pay them online. So just set up a reminder and just, for example, if you're going to make less than $100,000 and you know it's all going to be subject to self-employment tax, just pay 15% of it quarterly. And then you know you're going to save yourself a couple hundred or even thousands of dollars in penalties. Finally, and this is something that I would really like, I would encourage people who are interested in it to come to the workshop tomorrow, because I would like to go into it in a bit more detail for the people that it's going to be applicable to, but I strongly urge people to consider including some type of legal structure, such as an LLC. An LLC is a really simple legal structure that you can set up online, like in 5 minutes. And it doesn't complicate your taxes, but it adds that layer of professionalism and actually liability protection. So consider that. Most people, when they start out, they're just a sole proprietor, which is just kind of a nothing. And adding the LLC just adds you that extra layer. And it's, as I said, I think it's a good first step for most new business owners. Yeah, and in the workshop, we can talk about like what states are good for that, how to do it, and how to maintain it and all of that stuff. Now, I wanted to just finish with some other considerations. These are things that I hear people talk about that they sometimes don't fully understand. And I wanted to give you guys a bit of an executive summary as such. So you would know what these terms mean, or kind of what the news means to you as a globally mobile business owner. So one of the things that if you're it's always hard for me to tell how much of this people really paid attention to in the news, because as tax nerds, we were really, really focused on it last year. But the Trump tax reform, it was a complete sea change for taxes, and it passed, as you may know, in December 2017. But a lot of the changes are going to hit on our 2018 tax returns that we'll be looking at in the early part of next year. So what are the things that I think are most impactful for digital nomads? Well, the standard deduction was essentially doubled. So that kind of functions like an additional foreign income exclusion for you. So now if you're a single person, you get 12,000. So for example, if you make 100,000 in your business and then, you get another 12,000 deduction, you just think of that as extra room to play with, really. And then the actual marginal tax rates were lowered. So if you have income above the income exclusion, then that's just going to be taxed at a lower rate. Repatriating foreign earnings, this is something that I'd say let's talk about this more in the workshop. It's a bit complex, but suffice it to say, a lot of my clients would have been using a foreign corporation in their structure, which is, I think, still a really attractive option for a lot of people. But they had to repatriate all of the previously deferred earnings that were in their foreign corporations. So that was just, we couldn't have seen it coming, and we just had to respond to it, and it was retroactive. So it just happened on the 2017 returns, and going forward for you guys when you're considering your structure, just know that the environment is different than it once was. But I do still think foreign corporations can be a good option for a lot of people. So talk to me about that in the workshop tomorrow if you're interested. And then just finally, the Obamacare mandate used to apply a penalty if you didn't have health insurance. Actually, nomads who qualified for the foreign income exclusion, they got an exemption from it, but they're not going to need that anymore because the mandate is no more. So I'll talk really quickly about these two different filing requirements that can apply if you essentially bank outside the US. These are things that I hear them talked about in kind of various levels of fear almost, and I don't think that they should be approached that way because they're a little invasive, to be honest, but they're just requirements and they don't come with any additional tax, but the penalty exposure is pretty severe. So if you're going to be subject to either of these, just go ahead and file it, work with a tax professional. So the FBAR that you might hear about, this has been around for a really long time, and it's essentially just an additional reporting if you have non-US bank accounts that the aggregate value exceeds 10,000 USD at any point. So essentially, if you're doing any business banking outside the US, you can see how you'd hit that really easily. And it's fine, don't stress out about it, just file it because you don't want to be subject to the penalties. And then secondly, if you ever hear about this acronym FATCA, it's the Foreign Asset Tax Compliance Act. And it's essentially, it's almost like a duplicative reporting. The same stuff that goes on the FBAR also goes on the FATCA Form 8938, but the thresholds are just that bit higher. So just so you know, when you see people talking about these things, some of the forums that I see people are really wary of them. I don't know. I just think for my clients, if you have a requirement, let's just file it so you don't have to worry about potential penalties. And then just really quickly on foreign taxes, again, just for future thinking and planning, if you're going to be setting up a base in a foreign country and you're going to be paying taxes there, again, don't stress out about it. There's appropriate ways that we address that. And essentially what you do is you're not going to pay double tax. So even if you're making above the 100,000 exclusion and you're paying foreign taxes on some or all of that, we essentially apply those foreign taxes as a credit on the US return, so you're not doubly taxed. So here are some key takeaways that I just wanted to leave you with. Firstly, if you're able to claim the foreign income exclusion, you should do it. File a timely tax return, so your filing deadlines. If you owe taxes, ideally you'd want to pay them by April, but these extensions are available if you need them as well. The self-employment tax. One thing to note about that is, if you're going to be self-employed and you're going to have a business that you're going to operate location independently, let's talk about it tomorrow in the workshop because there are some structures that can alleviate some of your self-employment tax burden. If you have an FBAR requirement, go ahead and file it. The penalties are too high to mess around with. And then here's your to-do list. Track your days for the physical presence test. it's really best to do this contemporaneously throughout the year. Keep a spreadsheet, or, I've been looking around for an app, actually. There's no app to do this, and I kind of want to develop one. So if anyone's like a software developer or an app developer, talk to me, because there should be something that's easier than a spreadsheet. And then track your income and expenses if you're self-employed. Track them throughout the year, ideally on a monthly basis, so we don't have to go through a bunch of receipts in April. It's a lot easier that way. And then file timely. And if you're behind, don't worry, because actually you can catch up. So if you didn't know that you had to do anything and you've gotten a few years behind, there's actually a program that's available for you. So come talk to me about it, because it can be really useful for people to kind of come back into the fold of the IRS, the warm, loving embrace. So what I wanted to leave you with is this. There's no getting around the fact that it can be overwhelming, especially when you're starting out. You don't want to become a tax professional, maybe. I don't know. I don't mind it. It's not that bad. But you guys have other things to do with your time. So get the right people on your team, and then get out there and do what you do best, which is grow your business, enjoy this amazing lifestyle, and don't let the tax piece stop you, but rather kind of get the information and get empowered and get out there. So if you want to talk to me, if you have questions that are kind of you don't want to share with the entire group in the workshop, you can email me. You can schedule a consultation if you want to kind of talk one-on-one. And I've actually just launched a course, also on Teachable, which I really thought was filling a need for the people who are new digital nomads and new entrepreneurs, so that they could go into a lot more detail on all of this stuff and really get comfortable with how their taxes are going to change. So yeah, that's it. Thanks, everybody.